कितने साल ये गए नहीं इसने बोला ना बोला गिफ्ट कार्ड भेजा बोला आए नहीं
अंदर खड़े कर भाई बात खड़े कर भाई इंटरव्यू खत्म मार दी एक दिन में मेरे बढ़ा दी मेरे
আপনি যে ব্যক্তিকে কল করেছেন হারামি লোক তো ব্যস্ত আছেন অনুগ্রহ করে অপেক্ষা করুন অথবা
Good afternoon, everyone. Santosh sir, can we start?
Yeah, we can start.
Yes. Madam Kajal, please go ahead.
Yes, sir. Namaskar and good evening to everyone. Respected speaker today's webinar, Mr. Santosh D. Sir, our chairman, Mr. S.P. Sharma sir, members of ABP, esteemed participating registered valuers, and my colleagues. I, Kajal Gupta, manager at Divya Jyoti Values Foundation, RVO, and coordinator of this webinar, extend a warm welcome to you all in this program. The topic of today's webinar, as we're aware, is impairment of valuation as per accounting standards. As an asset is carried at more than its recoverable amount, if its carrying amount exceeds the amount to be recovered through use or sale of the assets, it is if this is the case, the asset is described as impaired. And this standard requires the enterprise to recognize an impairment loss. This is an important concept for valuers and will be discussed in details by our speaker. Mr. Santosh Dev, sir, unexperienced and a prominent member of our faculty, will be taking this session. Before I hand over the mic to him, I will briefly introduce him to you all. Santosh sir is a chartered accountant and registered value for asset class securities or financial assets. He is advising multiple startups on various issues, including finance, compliance, and fundraising. He is an avid speaker and is a regular at SIRC of CII, ICI, the Institute of Analytics USA, the Institute of Internal Auditors USA, and various RPOs. He has experience of industry as both executive in it and also independent professional. So over to you, sir, for a wonderful learning session of 2 hours. Thank you.
Thank you. So, thank you, Kajal, for that wonderful introduction. I'm just setting up my PowerPoint presentation. I hope it's visible to everybody.
Yes, sir.
Yes, sir.
Beautiful. I think the sunlight is a little bit glaring. Just give me one moment. Okay, I hope now it's a little normal. So thank you so much. Welcome you all for this evening session. Good thing that it is not between 2 to 3 or 3 to 4. After your lunch, you would have settled down, taken your rest, and now you're back here. Today's session would revolve around impairment of assets. I understand this session would be more leaning towards SFA valuers, but trust me, it's not only SFA valuers who are going to be benefited from this. Actually, in India, there is a lean more towards SFA. In accounting standards, it is common towards everybody. So all plant and machinery valuers, land and building valuers, and the SFA valuers would be benefited by this session. So let's move on and look at what the accounting standard 28 is going to talk about. And more importantly, we will be looking at how, as registered valuers, we are going to do services to our clients from the viewpoint of accounting standards. That's the main idea that we have of in imparting this particular session or the standard. Objective of the standard, accounting standard 28, we're going to, let me give you a broad idea, set the agenda. We'll be talking about the standard for 1.5 hours. Probably about 45 minutes of the time, we'll be looking at the standard perspective, what the standard says, and 45 minutes we'll be concentrating on how, as registered valuers, we can help the client, how, as registered valuer, we have to do the valuation, because this is not the normal valuation that we usually do. Here there is going to be a small change in the kind of valuation or the methodology of valuation that we're going to do. So those small nitty-gritties we'll look at in the 45 minutes. Last half an hour, let us keep it for our discussion. Now, why does AS 28 come into play? It has one major objective. The other objective is dependent on the major objective. It is to make sure that nobody is carrying an asset at a value lower or higher than the actual value that it would get the owners of that asset. So in the financial statements, you have the profit and loss account, which gives you the what is the profit or loss that this particular company is making. And then we have the balance sheet, which tells you what are all the assets and what are all the liabilities that this company is having. Now, profit and loss, we'll keep it, park it aside. from the look of the balance sheet, whenever we are going to calculate the net worth of the company, we're going to take all the assets, reduce all the liabilities, we're going to have the net worth or value of the company. NAV method, we'll go and do that usually. But what happens is, unless otherwise a trained professional or a valuer looks at the balance sheet and he's able to understand that the values that are given in the balance sheet are at cost basis, the value can actually be higher or lower than the value that is disclosed in the balance sheet. People would not be, as a valuer, if you look at it, you would make your independent judgment. But when common men look at it, they will not be able to make the distinction. When the general folk look at the balance sheet, they look at it and they assume whatever is given in the balance sheet is certified by a chartered accountant is going to be right. Now, to bring parity and to make sure that everybody is following a single standard and to make sure that none of the companies are inflating their assets, this impairment section has come into play, where they are saying that this standard needs to be applied with the objective of making sure that any asset which is having a lower value is not inflated and shown in the balance sheet. So it carries no more than their recoverable amount. That is the main objective. Then comes the secondary objective, where in case, because there was an impairment and you have impaired or you have reduced the value of the asset in the balance sheet, and later you found out that you have actually impaired the asset inadvertently, wrongly, then there is a mechanism for you to reverse that impairment also.
Okay.
So that is the subsidiary objective, secondary objective. And obviously at the point of impairment, also at the point of reversal, there are disclosures that are coming into play, where you'll have to go on and give the reasons to the readers of the financial statements, why you impaired something, how much did you impair, what methodology you followed, what is the amount. All this will be coming out in the disclosures part of it. Now, there are certain exclusions to this. In the case of inventories, AS 28 does not apply. In the case of construction contracts, AS 28 does not apply. Financial assets doesn't apply, and deferred tax assets, it doesn't apply. These four assets, your AS 28 does not apply. But a small change here, in the case of financial assets, though AS 28 does not apply, wherever Ind AS 36, which is an equivalent, instead of accounting standard 28, if you have started following Ind AS 36, and if the Ind AS 36 is applicable to you, in that case, even financial assets is within the scope of Ind AS 36. So the equivalent of accounting standard 28 in the Ind AS is your Ind AS 36, which deals with impairment of assets. The following Ind AS 36, even financial assets like subsidiaries, joint ventures, and associates, those disclosures, when you are doing, you'll have to check for impairment. Now, I'm going to summarize the entire process in a matter of 2 minutes. You will be able to understand how impairment actually functions, and then we'll go into great detail of each and every item. Now, number one, when it comes to AS 28, you don't have to dive deep every time to find out whether there is an impairment or not. You'll have to always look out for an indication of impairment. What is indication of impairment? This is again a primary process where you go on and look at the assets that are there. If it is a physical asset, you go on and look at the asset. In case of intangible assets, you look at the reports that are being generated. If there is a brand and that brand is generating you some revenue, look at the MIS that is being generated on a continuous basis. Look at whether what you have budgeted and what is actually what is targeted and what is actually generated is equal, or is it reducing. Look at the cost that is related to it, whether it is decreasing or increasing. These comparisons you can do, and based on this broad factor, a primary idea can be framed whether the particular asset is impaired or not. To give you a broad example, whenever you go on to do a land and building valuation, before you even go to that particular place, you have an idea of where that particular place is. Based on the address, you have an understanding of that location. If it is in the heart of the city, you would have made a judgment. And if it is not in the heart of the city, it is removed outside the city, not even in the sub-city, it's long outside the city, but the value seems to be high, then there is an indication that unless otherwise there is a justification for this higher value, it is going to be impaired. So first, what we are going to look at is the prima facie one, which is the indication of impairment. If there is no indication at all, then don't spend your time in calculating the impairment. If there is no indication, there is no requirement for impairment calculation also. We will leave it, pass on, move on. Who will do this? Not the auditor. The management of the organization will do it on a regular basis, when I will tell you in the next slide. Now, in case if you look at the particular asset and you understand there is an impairment, you went on and looked at the machinery is rusted, it's not been used for some time, there has been some damage to the machinery also, there is an indication, you have found there is an indication, then what should you do? Then you should do another second test, whether that particular asset can be assessed individually or not. Now, I'll give you an example, which will again come back in a slide later. You have a particular, so I'll take the example of my office. I have a fan, I have a computer, I have a chair, I have a desk. Now, how much of my revenue comes from me having that particular fan? Would I be able to calculate what is the benefit that this fan or air conditioner is getting me? I will not be able to calculate a value individually for that particular fan or an air conditioner. But if I have a machinery, if I own a printing shop and I have a printer, I can very well say that from this printer I am able to make so much money. But when it comes to certain businesses, certain assets, a group of assets function together to generate revenue. At that point in time, you might have to look at the asset, whether this asset can individually stand on its own and generate revenue, or should it stand with other assets together to generate revenue. If in case it needs to be assessed individually, then we move on to the next step, where we go on to calculate the recoverable value, recoverable amount. We will make an estimate of the recoverable amount. Again, great detailed discussion will go on to how to calculate recoverable amount. Next, if recoverable amount, so essentially in common general terms, if I have to explain recoverable amount, what is its value to me? Either if I sell it outside, how much would it fetch me? Or if I use it for my business, how much value is it going to add to my organization? That is the recoverable value. Now I calculate the recoverable amount and I compare it with the carrying amount. Carrying amount is your book value. As on that particular date, what is the value at which I am carrying it in my books of accounts? If that amount is going to be higher than my carrying amount, the recoverable amount, if it is higher than the carrying amount, then there is no impairment at all. If the recoverable amount, if I'm carrying it at 100 rupees, I have a particular asset which is worth 100 rupees, but I am able to derive benefit of 150 rupees by keeping that asset in my name, then there is no impairment at all. I am carrying it at a lower value only. This is not revaluation where I can go on to increase the value. Only in the case of revaluation, we will increase. This is impairment. If the value that I get from the particular asset is more than the value at which I'm carrying it, I am not going to apply impairment at all. I'm going to leave this section. But in case if the recoverable amount is lesser than the carrying amount, then I go on to do three things. The number one thing would be to calculate the amount of impairment, then pass entries and account for the impairment, and finally three, make disclosures, relevant disclosures of the process, relevant disclosures of where this impairment loss or impairment loss is being actually accounted. So these three things I'll have to do: make a calculation, accounting, disclosure. Now, when it comes to can the asset be assessed individually, we went on and finished this branch, we went on and finished this branch. Now we'll have to look at whether if the asset cannot be assessed individually, what should I do? Then there comes a concept called cash generating unit. We'll have to identify what are all the assets that will work together, identify all the assets, and what is the cash generating unit as a whole, how are they able to function? That we'll have to figure out. Now, when it comes to cash generating units, the moment you identify all the assets and then they are working together, you identify the cash generating unit, you go on to do the same thing that we did individually also. Estimate the recoverable value of the recoverable amount of the cash generating unit. If the recoverable amount is less than the carrying amount, we'll have to check. If it is not less, no impairment. If it is lesser, here there is a small change that we'll have to do. The amount where we calculate and directly we go for accounting. Here we'll have to do a intermediate activity, after calculation, we'll have to do an allocation of the loss that is generated, that is being created because of this impairment. I'll have to allocate it to multiple assets. All the assets that is forming part of this asset, I might have to allocate it. That is something that I'll have to keep it in mind. And this we'll look at it a little later. This will come somewhere around 4:15, not 4:15, 5:15 and odd. Will get, I think around 5 o'clock we'll get to this goodwill allocation. Not very complicated, pretty straightforward, understandable. Then we go on to do the accounting for it. Then we go on to do the disclosure for it. Same whatever we did with the individual assets. Now, when it comes to when I told you identification, or actually the term that I used there was indication. When I said indication, you might have to identify for the indication. What are all the indication that I should look for? That you should identify, you know. That is the process that we are going to do here. What are we going to do? We are going to identify the indications of impairment of assets. Why should I do it? Only if I know, if I look at it and there is an indication of impairment, then I am actually carrying the value in my balance sheet for a higher value, which I should not do it. Therefore, I'll have to do it for fair presentation of the financial statements. When should I do it? This is very important. It need not be done on a daily basis. It need not be done on a monthly basis. Even for the review purpose, for a quarterly basis also, you don't have to do it. Because it is a balance sheet item, you'll have to do it on the balance sheet date only. On the balance sheet date, if you are able to find out there is a indication of impairment, then you can go ahead and do a analysis. Otherwise, you don't have to do it. In the middle of the year, there is some indication that is there. Wait for the end of the year till the balance sheet date end, and then take the action. Otherwise, you till the time you don't have to take an action on it. This is not a continuous process. Now, how do I know what are all the what are all the indications that are there? There are certain external sources and internal sources of information that we might have to rely on, which comes in the next slide. And then finally, there is an existing indication that I have found out. What should I do next? Go on to calculate the recoverable. Now, I talked about external internal sources of information. What are all the external internal sources of information? External sources of information refer to external to the organization. Anything that is not related to the organization, but external to the organization, we are looking at it. Decline in the assets market value. You look at the particular asset in the market and you find out that the value of that particular asset has been steadily, it has been declining. Then automatically there is a, so I have a beautiful DVD player that I bought for, let us say, 10,000 rupees. I'm just going to give you very real world relatable examples. DVD player that I bought for 10,000 rupees. Sir, who uses DVD player? I don't know. I bought a DVD player. I thought it was cool. I bought a DVD player for 10,000 rupees. Now, when I actually, after I installed at my home and I started using it, I find out that in Amazon, it is sold for 2,000 rupees. Essentially, what does it mean? In my balance sheet, I will recognize it at 10,000 rupees. But in the market, the value, the technology has become obsolete. Therefore, people have started downgrading its price and it is sold at 2,000 rupees. The 8,000 rupees, I'll have to book it as an impairment loss. So that is an indication. You'll have to let us go on to the recoverable amount a little later. But at least I have an indication that the value has come down, decline in the market's assets market value. Significant adverse changes in the market. There is a regulation that has come. There is a regulation that has come which says that single-use plastic cannot be used in your particular state. Single-use plastic cannot be used. You have a beautiful machinery which you very freshly bought, which is into the manufacturing of the single-use plastic. What happens? The entire machinery cannot be used because the moment there is a regulation that has come, you cannot manufacture single-use plastic, automatically the machinery is obsolete. You will not be able to use it. That kind of changes in the market needs to be looked for. Market interest rate or discount rates changes. Whenever there is an interest rate increase, the repo rate increases, repo rate decreases, MCLR, all these rates, whenever there is an increase or decrease, it's going to have an impact on your revenues, because you're going to discount it and calculate the value as on today. There is going to be an impact on your revenues, impact on your value. Therefore, that is again an indicator of an impairment. Change in market capitalization, the entire particular assets market capitalization changes. What does it mean? People have lost faith in that particular technology. They are moving towards another technology, or they are moving towards another kind of asset. Then automatically it denotes an impairment, impending impairment. Internal, these are all external factors you have no control over. You just have to look at the market and make decisions. But these internal items you have control over. You go and look at the physically, you go and look at the particular asset. It has damages, then either you have an impairment. If there is an obsolescence, it is rusted, nobody is using it, you have your own reasons of there is an indication of impairment. Discontinuation or restructuring of operations, though there is no statutory regulation or the government has not forced you, you have decided I will not run this particular business, then there is a discontinuation of or restructuring of the operation from internally. Again, that needs to be considered. Finally, you have evidence available from internal reporting. At the point in time when you were getting this particular machinery ready, when you bought this machinery, you would have had your targets, your budgets, and your project report. To give a very easy example, there will be a project report that will be prepared. If you have bought it on loan, you'll have to prepare a project report, submit it with the bank to get the loan for getting this particular funding for this particular fixed asset. Now, when you look at that particular project report, you said you will make 2 crores, 5 crores, 10 crores in first year, second year, third year, and you are sitting in the second year, you are making hardly 50 lakhs. You projected 5 crores, you are making hardly 50 lakhs, then there is an indication. The particular asset you are not utilizing to its full capacity, there is an indication of impairment. You thought that it will not have any repair expenses for the next 3 years, but then already you have spent 20 lakhs on the repair expenses in the first year itself or the second year itself, then there is an indication of impairment. If you thought that putting in 1 kilogram of the raw material, you will be able to get at least 950 grams of the final material, but you are only actually getting 900 grams or 850 grams. You don't know what happens to the other 150 grams. It's getting wasted somewhere. Some problem, some mechanical problem is there. It is not able to refine it properly. All those things would form part of your internal reporting mechanism. These items are not exhaustive. This is what the standard gives you as a rope to hold on to. Doesn't mean that you should not swim on your own. Just make sure that you also do your own analysis, and the management has to do their own analysis to find out whether further impairment indications are showing up. If any indication shows up, as long as it's reasonable, you can go ahead and take up and do the impairment analysis. Usually management would not be bothered. They would not want to do this impairment analysis. Two things. For number one, it is a laborious process. Number two is once you start doing impairment, if there is an impairment, the value of the company is going to go down, because you are going to, why does an impairment happen? Because of an adverse event. Nobody wants an adverse event to be reported. Therefore, they usually do not do it. But as long as they are able to find out something, a good management should go ahead and account for impairment. Internal reporting, whatever I told you, it's going to be the same thing. When you look at it from the revenue perspective, revenue is reducing. When you look at it from the cash flow perspective, the cash flow is reducing. When you look at it from the operating profit perspective, again, it is decreasing. And when you look at it from the expenses perspective, the expense is increasing. So cash flow, profits, revenues, all this, if it decreases, or losses, outflows, and your expenses, if they are increasing, then automatically you have a understanding that there is an indication of impairment. Comes the major point. What is recoverable amount? Sir, you told me the amount is recoverable amount. I'll have to compare the recoverable amount. Carrying amount, very straightforward. Whatever is the book value, I'm going to take it as the carrying amount. Book value is my carrying amount. But what is recoverable? AS2 talks about the inventory will be valued at cost or net realizable value, whichever is lower. Here we are saying recoverable amount is net selling price or value in price, whichever is higher. You'll have to understand this. Most of you would understand it, but sometimes people like me, we get fixated in certain terminologies that sometimes it becomes a little tough to understand. Here, we are calculating the net recoverable value on a higher basis. Then compare this recoverable amount along with your carrying amount cost. Your carrying amount would be predominantly cost. You compare it, and there you are going to do only lesser. Whichever is the lesser amount, you'll have to carry it in your books. But for the calculation of recoverable amount, we are going to look at an external factor. We are going to look at an internal factor and compare. If I have a laptop in hand, if I'm able to make, by using this laptop, I'm able to make 1 crore. And if I'm able to, if I sell the laptop, I may only be able to make 70 lakhs. Which one would I prefer? 1 crore only I would prefer. In case, if I have it with me, I'll get 1 crore. But if I sell it, I'm able to get 1.5 crores. I will prefer to sell. So the value of that particular laptop to me is its best use, highest and best use. From that perspective, recoverable amount is the higher of net selling price and value. Net selling price is the external factor. When I say external factor, you look at the particular asset. If you have in very rare cases, if you have a binding sale agreement for that particular asset with some vendor, for whatever reason you wanted to sell, somebody wants to buy it from you, not the vendor, somebody wants to buy it from you, you have a binding sale agreement, then that would be your net selling price. In case if you don't have a binding sale agreement, which is the most common thing, you would not, your assets, why do you want to sell it? So it would not be there. Then you have to look out for the active market. How much is it traded in an active market? Laptops usually are sold in an active market. Second-hand market for laptops exists. Second-hand market for computers exists. Go into the market, look at whether there is an active market for the particular asset, and then you'll be able to get what is the price at which it is traded. In fact, sneakers, the shoes that people wear, there is an active market for it. Certain sneakers they sell for a couple of $1,000s. So active market exists for a broad range of lot of assets. Now, if the active market is also not there, then you'll have to go to the most recent transaction. It's not active. There is a market. You don't have it as active market. So day in and day out, you don't have a price quoted for it. But there is a market, and you there are transactions that are recorded quite some time back, not actively traded, but about 3 months before, 6 months before there was a transaction. You take that most recent transaction price as your net selling price. In case even that is not available, then you'll have to go make up with the best information available with the management. What is best information available with the management? I don't have a computer. I don't have a laptop. What price it is being sold, but I know how much is a PC sold in the market broadly with this configuration. What is a PC getting priced for? Based on that, I will make a comparison. So broad understanding. This price should always, net selling price should always be less of the cost of disposal. If there is going to be a cost of disposal for this particular asset, the transportation, or you have to do something to close this particular thing, then close the particular deal, then that net selling price would be after the price minus the cost of disposal. In this particular calculation, there is no SMC exemption. What is SMC exemption? In value in use, because it's a complicated process, the standard says, in case if you are not able to calculate, for small and medium companies, small and micro companies, you have an exemption. You don't have to go on to calculate the value in use. But in the case of net selling price, you don't have that luxury. You cannot say, oh, I am a small company, I don't know how much this particular asset is worth. No, you will have to calculate it. Let's jump on into value in use. Sir, value in use, you told me that it is a little complicated. What is the complication? Net selling price, at least you know how do you go ahead and do the valuation. There is binding sale agreement, straight you get one number. Actively, if it is traded in the market, straight one number, maximum 2 numbers can come. Active market, this is the price minus cost of disposal that you reduce, you get a value. Net selling price, straightforward. But in the case of value in use, you'll have to go on to calculate the estimated cash flows from this particular transaction, from holding this particular asset. All the inflows you'll have to calculate, all the outflows you'll have to calculate. Then what is the net cash inflow to the company you'll have to calculate, and do a DCF valuation where you apply a appropriate discount rate and calculate a single value that the particular asset would be able to get as and that value would be your value in use. So an entire valuation model TCF needs to be done for a single asset. The company has 10 assets, you'll have to do 10 such iterations. If the company has 100 assets, you'll have to do it 100 times. If it has 1,000 assets, 1,000 times you'll have to do this exercise, which will become a laborious process for the management. Two things here. That is the reason government has given an SMC exemption for small companies. You don't have to go ahead and pull your hairs off and getting a value in use, directly use net selling price and move on. But for larger companies, that exemption is not there. That is where us valuers would have a large, valuers would have a very large scope to do this service. To one, we'll do an indication analysis because the management might not have the expertise. They can engage valuers to do an indication analysis to find out whether there is an impairment indication that shows up anywhere. And two, you can go on and wherever indication is identified, you go on to do the recoverable amount calculation. Both net selling price will be able to do, value in use will be able to do. Give them what is the impairment that they have to bring out in the balance sheet. Very clearly, we can bring it up. So this is the opportunity area. Now that we have broad understanding, let us get into value in use. I'm shifting gears here. I moved on half an hour. We have completed the basics. Then this area is where valuation nitty-gritties are going to come in, value in use. And then once we complete, again, I'm going to shift gears and I'll go back to the general area. Now, when you calculate value in use, usually P&M valuers, LNB valuers, and SFA valuers, we go on to use the income approach for valuation. What happens is we get some projections from the management and we go on to do the valuation. Most of the time, what happens is whatever they are giving, we will not be able to very clearly understand on what basis have they done this projection. In the case of this particular case, though if we are signing or not, the standard says look at the reasonableness or supportability of the assumptions. Nowhere else in any of the other valuations, a mandate has been given on looking at the reasonableness or supportability of the assumptions. It is not given in any standard. It's not given in any law to look at whether it is reasonable or not. But in this accounting standard, it's very clearly given reasonableness and supportability of the assumptions on the cash flow projections needs to be checked by this. Checked by the management. When we take up the assignment, management has hived off that responsibility to us. So we should check for the reasonableness and supportability. And greater weight should be given to external evidence. Always external evidence is the primary factor. That is the reason usually we use market approach first, which takes into account the maximum external evidence or market observable information. Second, we come to income approach, and third, we come to the cost approach. So because it is income approach, external information, keep looking out for external information, bring it out into the valuation. Cash flow projection should be based on the most recent financial budgets, and it should be for a maximum period of only 5 years. Two things. Whenever you are doing a projection, whenever the management gives you a projection, get the latest budgeted information. Nothing from the 5-year plan, which was devised 4 years before. Don't take that kind of information. Ask them to give you a projection as it stands today. In case if they have a process of having a review for every 3 months and only last month it has been done, the budget and projections are available, take that. That is okay. The most recent one you'll have to take. Don't take the 5-year plan which was done 4 years before. Don't take that. Take only the most recent one. This is the past. Looking at the future, always do a valuation for a maximum of 5 years. I am not saying this. It is given by the standard. The standard says the maximum period that can be taken and it can be justified is only 5 years. Unless otherwise, it can be justified for a higher period. Normally, they give you a thumb rule of 5 years. It's nothing wrong if you can take it for 7 years or 8 years. But if you're taking it for 7 years or 8 years, just make sure that that you are also making an analysis and you are making an reason for why that for 6 years or 7 years is taken. In the case of, in most cases, last week we discussed about intangible assets. In that, sometimes what happens is the entire period that can be taken can be for only the usage of the period of that particular intangible asset can be only for 7 years or 8 years. And there is nothing beyond that. So at the end of 5th year, you cannot do a terminal value calculation at all. Rather go on to do the calculation for 6th, 7th and 8th year also. If that kind of project-based valuation is being done, then you can use for a longer period. But you cannot do a valuation for 35 years or you cannot do a valuation for 95 years, 100 years. Don't do that kind of valuations or projections. Now, after these two, the most important thing that the standard says is the growth rate. Usually at the end of the 5th year, we go on to calculate the growth rate. The growth rate, the formula we know, free cash flow for the 5th year, which is the last year, into 1 plus growth. So we calculate the 6th year value divided by KE minus G, the required rate of return minus the growth rate. We calculate the value. Sometimes what happens is, over enthusiastically, the management would say, we would grow on 40% in the next year, 80% in the very next year, then we will grow on to 100%, 150%, 200%, and they keep growing. The growth will grow. The growth percentage will grow. Like velocity, when you push it even harder, it is called acceleration. The same kind of acceleration cannot happen in the growth rate. Growth rate can be there, it can be a steady growth rate, and in most scenarios, it will be a declining growth rate. Any company, it will reach its peak and then it starts to decline. So you can have a steady growth rate or you can have a declining growth rate. Just make sure that there is no exponentially growing growth rate. I hope everybody knows by now the story about the chess competition. Where the founder of chess, I don't know, it's not a real story, it's a fictitious story, but still it's good to hear. The person who invented chess, he was the undefeated champion in that particular thing. Came, so the king called him, he told him, boss, let's do one thing. I'm ready to give you a gift. What do you want? Ask me anything, I'll give. And this person said, I'll take one rice for the first square in the chessboard, 2 rice for the next square in the chessboard, and you keep doubling it for the 64 squares. By the time the king was able to get him the rice for the 7th or the 8th, the block itself, the square itself, he was out of all his will. So that is the concept that we are seeing it here also. The moment you say your revenue is going to double, your profit is going to double every year for the next 10 years, then it is as good as saying that you will be able to own the entire world in the next 15 or 20 years. That is not possible. So just make sure that whatever growth rate is you're taking is reasonable, number one. Number two, it should be at the end, it can be steady or it can be declining. And one rope that the standard gives you is make sure that it does not exceed the long-term average growth rate of that product, that industry. The most commonly used yardstick is the GDP. The country's growth rate can be taken. Make sure that your growth rate that you're taking for this particular company does not exceed the country's growth rate itself. So at the end, automatically, all the growth rates of all the companies put together only come to the GDP. It cannot. Your company's growth rate cannot exceed the GDP. It can be higher for the first 5 years of projection, but the terminal growth rate should align with the GDP. Moving on to estimates of cash flows, what should we do? We'll have to do a projection for the inflows from the continuing use of the asset. Usually, when we do a valuation, we do a projection for all the income of that particular company. But in this particular case, we'll have to do a projection of cash inflows from continuing use of that particular asset. By using this asset, what business will I do? What revenue will I get? What inflows will I get? That alone we'll have to take. Projections for cash outflows that are necessarily incurred to generate the cash inflows. For generating that cash inflows, what is the cash outflow that I'll have to incur? That you'll have to bring in, which is your expenses. And finally, net cash flow. So this is A, this is B. Finally, terminal. When I close out on this asset, is there any disposal expenses that will be there? Or if I dispose it of as a scrap, will I get any income? That also needs to be considered. So 3 things we'll have to consider in the cash. Important point that we'll have to note here is don't account for receivables, payables, or balance sheet items. The moment we calculate receivables, payables, and balance sheet items, we are saying we are taking something that has already happened. The revenue has already been earned, but it is not brought into the balance sheet, brought into the value because it is not from today. It is there in the. That's the reason it is in the balance sheet. The moment receivables has been brought into the particular calculation, automatically it will mean as if we are double counting. If the asset is going to be for only one more year, if I take receivables, it is as good as taking 2 years of revenue into the calculation. So from the date only you don't take it from the previous receivables, you are not going to bring it into the calculation. Now, sometimes there is a little bit more complexity in reading the standard. I would, in the interest of you understanding it, I would request you to read the point A. Assimilate your thought. What is your thought? What does the standard try to say? You can try to bring it out in your own statement. If you can put it in the chat box, well and good. If you want to speak, that's still fine. Read point number A. What is the standard trying to say? There's a small variation that you'll have to use. There is no comma there. I did not miss a comma. There's no comma in the standard only. There is no hyphenation. There is no tab. It is a single sentence. Read it. I'll give a minute more. Read it and try to frame your own understanding of what that standard is trying to say, and then we will take a we will have a joint conversation about it. Cash inflows from other assets, not the assets under consideration, are to be excluded. Beautiful. Thank you, Ms. Anuradha. That's the context that they're trying to bring out in a very convoluted fashion. Cash inflow from assets, which means the assets that generate cash inflows from continuing use that are largely independent of the cash inflows from the asset under review. So here they are calling it as assets. Here they are calling it as asset. Any inflows that does not that generate cash inflows continuously but does not form part of your asset under review, that cash flows you'll have to keep it separately. So receivables, though receivables per se is an asset, it generates cash flow, but it does not pertain to this particular asset. The asset has been used and already a new asset has been created as receivables. Keep it there. Same thing goes for payables also. Cash are outflows that relate to the obligations that have been already recognized as liabilities, you leave it off. Here they are very simply, in point number B, they very simply worded it. Cash outflows that relate to obligations that have already been recognized as liabilities, you have to leave it off. In the same way, apart from these two, there is one more point that you'll have to consider, very important point. Future cash flow should be estimated for the asset in its current condition. Give you an example. There is a particular machinery which can process 1 kilogram of a particular raw material to make 950 grams of the finished goods in a day. So every day I will be able to only process 1 kilogram of a particular product, raw material. Now, when I want to calculate the cash flow, both inflow and outflow, I'll have to look at only maintaining that particular 1 kilogram limit. In case if I am considering 2 kilogram, increase in the potential, that is going to be a problem. If I'm looking at making a capital expenditure to increase its value, future capital expenditure to increase its carrying capacity from 1 kilogram to 2 kilogram, then I am not valuing this asset. I am valuing a completely new asset which is able to process 2 kilogram raw materials. So the idea and objective is to value this particular asset which is able to process only 1 kilogram. So I should concentrate only on this. I should not take that. The second thing that I'll have to be making sure is that I cannot also take the inflow, cash inflows, revenue that I will be able to make. That also I should make sure that I am not taking the inflows from 2 kilogram which being processed, which will give me 1900 grams of the finished goods. That I should not take. So both inflows and outflows, it should not consider an excess capacity. In its current condition, what will it be able to do? Now, sir, it is able to process 1 kilogram of my raw material, sir. 3 years down the line, I find out that it is not able to process that 1 kilogram. There is a fall in its capacity. It is going to somewhere around, it is only able to process 800 grams. Can I do some repair work to make sure that it comes back to 1 kilogram? Yes, that is allowed. Any repair or maintenance that is related to keep the level or keep the asset at its own capacity, at its own level, that can be done. So future restructuring to which an enterprise is not yet committed cannot be taken. Future capital expenditures that will improve or enhance the asset in excess of its original asset's standard of performance cannot be taken. These are all inclusions. Estimates of future cash flows include future capital expenditure necessary to maintain or sustain the asset, which is what I told you. You can take repair expenditure even if it is capital in nature. One part needs to be replaced, still fine, as long as you are maintaining, you are not enhancing. Estimates of future cash flow should not include, apart from that, it should not include cash inflows or outflows from financing activity. Because of the getting the asset, I had some interest expenses. Can I take? No. Because of having the asset, I am getting some monetary benefit in the form of interest or in the form of from the bank or from the government. I am getting some grant. Can I take that? No. All those inflows, cash inflows cannot be taken. Income tax on receipts or payments, I cannot take. Income tax should never be considered as part of my inflow and outflow. Usually in our DCF calculation for other valuations, we take income tax. We only take profit after tax and do the calculation. For the purpose of impairment valuation, income tax should not be factored. This is one thing. The next thing is, we'll have to look at the future cash flows. Two ways of looking at it. So I'm going to stop here. I'm going to address one quick question in between. When an asset is being used, say for the first single shift today, but the management plans to use it for 3 shifts in the near future, that additional utilization be considered for valuation? Yes, that can be considered. If it can be run on 3 shifts, that's fine. But enhancement for running it for 3 shifts, if I have to install an additional motor, or I might have to install an additional capacitor in that particular machinery, that cannot be taken. If in its current condition itself, if it is capable of running 3 shifts, but I am running it for only 1 shift, but I am saying I am going to run it for 3 shifts and do the projection, that's fine. But the machinery is made for only 1 shift, but I am planning to make it run for 3 shifts. Therefore, I am going to make a capital expenditure in such a manner that it runs for 3 shifts. That cannot be done. So what is its current condition today? Without any change, capital expenditure, will it run for 3 shifts? Or should I make any capital expenditure for it to run for 3 shifts? That I'll have to consider, because today I am kind of valuing the asset as on today. No, the entire idea of the standard is to find out what is its value today. As it stands today, what is its value? So if it is already having that parts, if it is already having the power backup to run for 3 continuous shifts, it's fine. But if it does not have it, I cannot enhance it. That's the idea. Now, I'll give you an example for the last point. Before that, Anuradha madam, I hope I answered your question. If you have a question, I mean, if you want to explain further, please, you can unmute yourself and you can ask. then no problem in interacting in between, because this is that kind of a chapter where interaction gets more clarity. This is because everything is prose, everything is directly theory, everybody's interpretation would be different. So welcome your participation also. When it
Yes,
comes,
sir. Why
yeah.
that is clear to the extent that if we are valuing today and today it is being used for a single shift, then it makes sense not to take the further plans into consideration for future cash flows. Because in any case, even if you are not adding anything to the asset, you would be adding something in terms of manpower or other infrastructure, which may not relate directly to the asset, but more to operating that asset for the additional shifts.
Correct. That can be taken. All the expenses directly related, income also will be taken, expense also will be taken. But only
Right, sir.
capital assets extra you cannot take.
Right, sir. Understood.
Okay. So now jumping on to the last point, explanation of the last point. Now I have a beautiful asset which stands in Washington. I put that particular asset in Washington. It makes a particular product in Washington. Now, all the revenue and expenses happens in US dollars. I am a company which is sitting in India. All my revenues, reporting, everything happens in INR. Sir, what should I do whenever I do this calculation? All the revenue should I translate to Indian rupees? And then all the expenses should I translate to Indian rupees, make the calculation and arrive at the value? Should I do it that way? No. The standard is very clear here. Whenever you have an asset which is there in a foreign country, or its revenues and income, revenues and expenditures are outside India, make the calculations in the foreign currency. You get $10, $20, $30, $40, $50 for the next 5 years from that particular asset. Keep it in dollars only. All the expenses also you calculate in dollars only. Do the cash flow analysis, the projections in the dollars. Calculate the discount rate for dollars only. Don't calculate the discount rate in rupees. Indian discount rate is different. When you are doing your projections in dollar terms, calculate your discount rate in dollars. Then you do the discounting. You arrive at a value. This value also will be in dollar. After you do that, then you make a translation. Single translation you will make, where you convert the USD to Indian rupee, and you go on to compare it with the carrying amount that is there in your balance sheet. So that you might have to, that analysis you might have to. So the concept is simple. Not every value needs to be converted to Indian rupee and then the assessment. Do the assessment, bring it down to Indian. Going further, because the projections are taken before income tax, your discount rate also should be pre-tax rates. Because all your calculation in your general SFA valuation, we make a calculation profit after tax. Everything is after tax. Discount rate also will be after tax. Here everything is before tax. Therefore, your discount rates also should be before tax. Certain items that you'll have to consider before you calculate your discount rate. The time value of money needs to be considered. Pretty straightforward. And then the risks that the future cash flows will differ in amount and timing from the estimates that you are making. That also should have to be factored into your discount rate. So this is a normal thing that we usually do. Yes, it's the normal thing that we usually do. The standard is making a little bit more elaboration on this matter. Now, in case if a valuer is, because it is not written for the valuer, it is for the management. It gives you a broad understanding of what are all the areas that the management can use to find out what is the best discount rate. It gives weighted average cost of capital as used by the capital asset CAPM, capital asset pricing model. Use enterprise incremental borrowing rate and use market borrowing, other market rates that are available. You can use this as comparatives. So the risk-free rate, definitely my discount rate should be more than the risk-free rate. It should be more than the incremental borrowing rate also. Probably it should be more comparable to the CAPM rate. So it gives a broad understanding of what are all the other rates that can be taken into consideration and compared. it should reflect, these rates should reflect the way the market would assess the specific risks associated with the projected cash flows, and they exclude the risks that are not relevant to the projected cash flows. Make sure that it is an asset specific discount rate, not a company specific discount rate. Company specific discount rates will be taken as a comparative, but from there liquidated down to get a little deeper into the asset specific discount rate. It should also have take into consideration the country risk, the currency risk, the price risk, and the cash flow risk. I don't want to get a little too deep into what each and every risk means, but then the currency risk, since we anyway discussed, when you calculate your discount rate in dollar, you will take the US markets functioning. If that particular industry, or what is that particular industry performing against S&P is what we will compare to calculate the premium. But in India, I will take that particular industry, I'll compare it with Nifty or BSE Sensex. So this kind of comparison would be automatically boiled into the country risk and currency risk. Now, most of us use a single discount rate. We usually calculate the KE as a single discount rate, but it is not a mandate that you'll have to use a single discount rate. You are actually allowed to use different discount rates for different years also. That is perfectly allowed, but you should know how it works. The first year I can say it is 10%. Next year I can say 12% or 13%. But when I calculate for 2 years, I should be very careful how I am applying it. So when I say 10%, 100 rupees will become 110 in the first year. And then when I'm saying 20% for the second year, this 110 will be multiplied by 20%. I cannot take 20% for the first year and second year. So the way that 20% is only restricted to the second year, that way of calculating it, we will have to make sure that we are very accustomed to it before doing it. So that's what the standard also says. Single discount rate is perfectly fine. Normally we use that. However, an enterprise uses separate discount rates for different future periods where value in use is sensitive to a difference in risk for different periods or to the term of structure of interest rates. We can do it. Make sure that you are taking necessary precautions and you have a very good understanding of what is happening, how we are going to do it. Now, again, I'm shifting gears here. We are going to look at recognition. So again, we are coming back to the general topic. Sir, I have calculated the recoverable amount. You told me what is, I did not get deep into the net selling price because it's pretty straightforward. This is where value come into play. So I went into value in use. Now, once we calculated the recoverable amount, I compared it with my carrying amount. I found out that the recoverable amount is much lower than the carrying amount. What should I do next? Immediately, I'll have to go on to recognize. I have a lower value. First thing that I'll have to do is, the entire objective is to reduce the value of the asset. So go on to reduce the value of this. Carrying amount or recoverable amount, whichever is lower, needs to be recognized. So if I'm carrying it at 100 rupees, I found out the recoverable value is only 80 rupees. The 20 rupees I need to reduce from the value of the asset. Asset is debit. Since I'll have to reduce it, I'll have to credit it by 20 rupees. Straightforward. Now, what happens to the other credit of 20 rupees? Where does it go? Straightforward, it goes to the P&L. Any impairment loss, unless otherwise in special scenarios, which will come in the next paragraph, it will go to the P&L. It's an expense, write it off in the current year itself. Now, in the case of previously revalued asset, that asset was already only 80 rupees. What we did is we did a valuation and we increased it to 100 rupees. Now you have found out that there is a revaluation was wrong or revaluation does not hold good now. I want to reduce the value. What should I do? In this case, when you revalued the asset, you would have created something called the revaluation reserve. It will be there in the balance sheet itself. The credit part is pretty straightforward. The assets value will be decreased. But the debit part, you don't take it to the P&L. In case of revaluation, reserve exists for this particular asset. You go on to reduce the revaluation reserve. Any revaluation reserve, you cannot go and set it off. Only if the revaluation reserve has been created for the purpose of increasing the value of this particular asset, you have created that, then you can set it off. So if it has been created for some other asset, you cannot touch the revaluation reserve, take it to the P&L only. But if it has been created for increasing the value of this particular asset in a previous year, then you can set it off with the revaluation reserve. Then 10 rupees, I set it off with the revaluation reserve, sir. Only 10 rupees was available. What should I do with the next 10 rupees? Remaining 10 rupees, take it to the P&L. Now, it was straightforward, no? We will go into the cash generating unit. Now, as I told you, as much as you are able to do a valuation or do an analysis, go to the individual specific asset as possible. In some cases, you will not be able to do it. 4 or 5 assets together, thousands of assets together, 10,000 lakhs of assets together, they work in tandem to make revenue for the organizations. In some cases, those cluster of assets, it's going to be called the cash generating unit. This is a very classic example. A mining enterprise, they have a private railway line. They have in very colloquial terms, they have a train. The train runs, the engine runs, it carries all the mined resources to the port. Now, what happens is, I look at that particular train and it looks very damaged to me. I found out, oh, this train there is an indication of impairment in this particular railway line or in this particular train. So I have to do an impairment analysis. I'm going to do an impairment analysis. I'll be able to get the net selling price straightforward. I'll be able to look at the asset. I'll get a net selling price. But how do you think I'll be able to get a value in use for this particular asset? It's not possible. This particular railway line individually will not add any value to the organization. Only if the mining crane does the pulling of the material into this train, it will be able to transport it. Only if the ploughing engine is able to plough it out, then the crane would be able to carry that particular debris into the railway engine. So then again, there will be multiple assets that will be there, which will all work in tandem to make a revenue. So for this railway line alone, I will not be able to get a individual value, internal value in use, I will not be able to calculate. Therefore, I go on to the cash generating unit concept. So in these cases, I will have to value the mine as an entire cash generating unit in a single way. Now, another example, I have 5 buses. I have a corporation contract which says that I can run 5 different routes. Or I have 10 buses. I have 5 routes that the corporation wants me to run. But the terms of the contract states that I cannot stop one particular route. So I cannot choose to run only 4 routes. If I am running, I should run all the 5 routes or no routes at all. I've accepted, I've signed off on the contract, and I've undertaken the assignment. I'm running all the 5 routes. Now, one day I find out that of the 10 buses that I have, 1 bus is damaged. Can I do an impairment analysis for that 1 bus? No. Why? Because the contract states that value in use for 1 bus I cannot calculate, because the contract states I cannot stop that particular 1 bus. Anyway, I'll have to run for all the 5 routes. So I'll have to fly all the 5 routes, 2 buses per route. I'll have to anyway run. I have no other way, but all the 10 buses should to be clubbed as a cash generating unit, as a single cash generating unit. If that clause, if that condition is not there, each route can be calculated as a separate cash generating unit. Because this clause is there, all the 5 routes together will be calculated as a cash generating unit. Let's jump on to cash generating unit. Certain points that we need to understand. EGU should be identified consistently from period to period. In Chennai, I have a particular machinery, let us call it C. With that particular machinery, I run my show here. In Bangalore, I have a machinery called B. In Delhi, I have a machinery called D. Now, last year, these C, B, D were there in their own places. Now, this year, what I did is I take machinery C from Chennai, put it in Bangalore, and from Bangalore, take machinery B and put it in Chennai. This year, when I go on to calculate a cash generating unit, the machinery, all the other machineries in Chennai are still there, but only this machinery C was taken away and B was brought in. There is a change that has happened. In case of such change, identification of that asset from one cash generating unit, it has moved to other cash generating unit. as long as it is justified, and along with the justification, a disclosure has happened, it's still fine. 1 second. I might have to put my mobile on, sorry. So this change in assets from one cash generating unit to another cash generating unit, if in case it does not happen, you don't have to separately do anything. Consistently, if it is followed, move on. If it is, if a change has happened, then you'll have to identify it, and then you'll have to justify it, and you'll have to disclose it. Now, in certain cases, what happens is there will be a long process, and in the long process, there will be one element that will come out which has an active market. I'll give you an example. Gold, from the mine, gold is excavated, gold ore is excavated. There is machinery A. You put all the gold ore in this machinery A. It cleans and it makes 22 karat gold blocks or 24 karat gold blocks. This is one process. I don't sell any gold blocks. I only sell gold jewelry. Whatever gold, 24 karat gold that is generated, I put it in machinery B. This machinery B takes the gold jewelry, 24 karat gold, it mixes it with a little bit of copper, and it makes beautiful jewelry. So there are two machines. Machine A, machine B. Machine A converts gold ore to 24 karat gold, and machine B, which converts 24 karat gold into 22 karat jewelry. Now, when there is an active market for the intermediary product, for the output of one machinery, it is already available, then what we can do is, what we should do is, we should split that entire process into two processes. Machinery A can be machinery A and the process A, whatever assets that are there, that should be seen as a separate cash generating unit. Machinery B and all the assets that help in creating jewelry from the 24 karat gold should be treated as another cash generating unit. Sir, but I did not sell any gold outside, or I am not buying any 24 karat gold from outside. Still, as long as an active market exists for the intermediary product, which is your 24 karat gold, consider the open market. In the open market, whatever the value it is sold, you consider it as the revenue for machinery A, and the first process CGU value, you consider it as the revenue. And the same 24 karat gold, you consider it as the expenses. Whatever is the market price, consider it as an expense for machinery B and its cash generating unit. And separately value machinery A and its allied units, machinery B and its allied units as separate cash generating. This is the context that the standard gives. Now, when it comes to cash generating unit, liabilities come into play. Oh, there are some questions. If it is used for 3 shifts, its economic life will be reduced. Yeah, okay. So that is, I think, links back to the previous question. Yes, it does have an impact. If it is run for 3 shifts, if this particular asset is supposed to run for 15 years, it will run for only 5 years, 6 years, 7 years. That needs to be brought into account. It needs to be accounted for. In case if you are doing a repair, so part by part, if you want to make a change in the capital asset also, that's still fine. You have the asset, you want to change one part of it, not necessary, you'll have to scrap it. If you so the computer I changed the RAM once because the RAM was not good enough. Then the hard disk was not good enough. I put it an SSD hard disk. So like that, part by part, if you want to change to keep the performance at the same level, that's still fine. Now coming back to liability measurement of CGU, this is going to be interesting. This is a problem. I will be able to also understand whether we have taken away any good takeaway from the session is there or not. I will be able to assess. Now, in case of cash generating assets, when individual assets are valued, no problem. There is no question of liability also at all. But when it comes to cash generating units, some cash generating units will inherently have a liability also associated with it. I will explain it through an example here. In this example, different mining operation. there is a word, beautiful word. I think it's overburden. Overburden. There's this beautiful word called overburden, which means all that is above the mining area, that's called the overburden. Any house, any debris, any land, soil, mud, anything that is there above the mining area, that is called the overburden. When the mining companies are supposed to remove this overburden, do the mining operations, and at the end of the contract period, you cannot just like that leave the mining area. You'll have to replace that overburden, and then you'll have to leave that particular place. So this overburden, when the company starts working on it, the moment they remove it, they will recognize a liability for the expenses that they'll have to incur at a later point in time to fill this particular place, to fill up the overburden. Now that liability will also form part of your CG. In this case, the provision that they have created is for 50 lakhs. So the operations is there, carrying amount comes a little later. 50 lakhs worth of liability provisions they have created, because they'll have to spend 50 lakhs to bring in other materials and put it in the place of the overburden. Now the enterprise is testing the mine for impairment. The cash generating unit for the mine is the mine as a whole, because it's a CGU. The enterprise has received various offers to buy the mine at a price of about 80 lakhs. Binding sale agreement, they are able to figure out 80 lakhs that you have. So that is your net selling price. This price encompasses the fact that the buyer will take over the obligations to restart the overburden. What does it mean? The obligation or the liability is already baked inside this price of 80 lakhs. So separately 80 lakhs I don't have to give, they will handle. Disposal costs of the mines are negligible, so there is no disposal cost. The value in use of the mine is approximately 1.2 crores. I did a DCF. I found out that the value of the mine, in value in use of the mine, is 1.2 crores, excluding restoration cost. So excluding, because restoration cost means 1.2 minus 50 lakhs would be my net value. So 1.2 crores minus 50 lakhs, that will be 70 lakhs. The carrying amount of the mine is 1 crore. Now you tell me whether there is an impairment or not. One value that I did not, that went on in the previous slide is, how much was it? 50 lakhs. Okay. 50 lakhs was the liability value. That was the only amount that was there in the previous slide. Okay. Tell me, is there an impairment or not? You want, try to put it in an Excel. Each and every value, put it in an Excel for comparison. Just make sure that you are using the includes and excludes restoration costs properly. Come on, it should be easy. Whether there is an impairment or not. If you are able to answer this, I think this concept is understood. Also, all the other concepts, the entire calculation of recoverable amount is understood. Fine. Let me give the answer. Pretty straightforward. Three things that I have to look for here. Okay, there is an answer. No. Okay. Fine. I think the answer is right, but let's go through the process. The carrying amount that I'll have to find out. The carrying amount is 1 crore and there is assets value is 1 crore and there is a liability of 50 lakhs. So the net carrying amount is 1 crore minus 50 lakhs, which is 50 lakhs. Then I'll have to look at the value in use. I'll have to look at the net selling price. Net selling price is straightforward. It is given as 80 lakhs. 80 lakhs is the net selling price, which is where the liability is already baked in. So I don't have to reduce 50 lakhs more from this 80 lakhs. Then I have the value in use, which is 1.2 crores. That excludes restoration costs. So from 1.2 crores, I'll have to reduce 50 lakhs. So value in use is 1.2 crores minus 50 lakhs. I arrive at 70 lakhs. So value in use is 70 lakhs. Net selling price is 80 lakhs. And I have a carrying value of 50 lakhs. Compare net selling price and value in use, 80 lakhs and 70 lakhs, whichever is higher. I'll arrive at a recoverable amount of 80 lakhs. I compare it with my carrying cost of 50 lakhs. I'll be arriving at approximately 80 lakhs is higher than the carrying amount of 50 lakhs. I don't have to do an impairment for this particular case. So that's the idea. How liability functions and also how recoverable amount is calculated for broad understanding. Now comes this interesting concept of goodwill. Again, we are going back to goodwill calculation. I told you there is a small difference between your individual asset impairment analysis, accounting, and there is a small degree of allocation that happens in the case of cash generating units. An individual asset usually does not carry a goodwill. But when it comes to cash generating units, sometimes what happens is it will carry a goodwill along with it. I bought 10 different items from a particular person in Mumbai to set up my firm. And then I found out that he already has a brand name built in. He has a trademark. I have also accounted for it. Still, I am ready to pay. After putting in all the assets value, it comes to 100. Trademark, I give it a value of 20 rupees. Still, I pay him 130 rupees. That 10 rupees extra that I paid him, I'll have to account for it somewhere. I account it as goodwill. Not all intangible assets are goodwill. Not all goodwill. I mean, goodwill is an intangible asset, but not all intangible assets are goodwill. As long as I am able to identify it as a separate intangible asset, I'll have to recognize it as a separate intangible asset. That will not come into play here. But where I have paid more over and above without a particular reason, without identifying a specific asset, that will be taken as a goodwill. It will be there in the balance sheet, right? I am going to skip this bottom up and top down testing. I'll give you an understanding of what happens. When you have a group of assets for which individual value is assignable to each asset, and there you have a fictitious asset which you don't know why you have created. It is created for the purpose of transactional reasons. You have created that particular asset, and now you have come down to a point where you found out that the value of that entire cash generating unit has reduced. Which asset do you think should be first hit, or which asset do you think is actually not performing? I am looking at, so when I calculate value in use, I thought when I bought the particular asset, I thought it would be making hundreds of crores of rupees. And that's the reason something that is something for which I'm supposed to pay 100 rupees, I paid 200 rupees or 150 rupees, 50 rupees extra I paid. And the 50 rupees is recognized as goodwill. Now I go on to find out that 100 crores is not possible. And I'm able to make only 50 crores. Which one should I be able to touch first? Which asset should I touch first? It would be the goodwill. Because when I budgeted, when I bought it, I have factored something inside. It's not happening. The first asset that needs to be affected would be the goodwill. So your credit should happen first towards goodwill and then towards the assets, other assets on a pro rata basis. Take all the assets, keep it separately. Take goodwill, keep it separately. The loss that you calculated, impairment loss that you calculated for the particular asset, first impact will be given on the goodwill. Then whatever is the remainder amount that is there, you go on to do a pro rata analysis and you hit it on the all the different assets in the cash generating unit. Now, if you are able to determine the recoverable amount, the value in use and the net selling price of individual assets, goodwill you cannot do anything. So first you will clear it out there. But for other assets, if you are able to do it, you should not go below the highest of net selling price or value in use or zero. Whichever is the highest value, it can go only up to that level. Don't reduce the value of an asset below zero. That's the takeaway from the final point. Other two, it's pretty straightforward. Individually, if you have assessed how much ever is the value, that you should bring out. And the important moving point is if determinable. You don't have to break your head. Because you are not able to determine the individually only, you have gone to the cash generating unit level. But if there are 10 assets, 5 of which 6 or 7 assets you can individually determine, and for 3 assets you are not able to individually determine, it is forming a part. Because of that, you have done a cash generating unit analysis. Then you, wherever possible, you do this analysis. Now comes the reversals. Reversals happens for individual assets also, CGUs also. The increased carrying amount of an asset due to reversal of an impairment loss should not exceed the carrying amount that would have been determined had no impairment loss been recognized for the asset in prior accounting periods. I'll take this off. I just read it. I don't think it is going to make any difference, but I'll try. I should have said this before. I should have explained this before, and then I should have brought this up. I had an asset which is worth 100. When I say 100, it is always 100 crores, sir, so that you'll be listening to it carefully. 100 crores worth of asset is there. 100 crores worth of asset, I found out that there is an impairment that has happened last year, 2023 financial year. I find out that there is an impairment that has happened. For whatever reason, I have done an impairment analysis. 100 crores it was worth last year. I have brought it down to 80 crores. 20 crores loss I have booked in my P&L, profit and loss account. I have booked it. Now this year I go on to do an analysis. 31st of March 2024. There might be an change. There might be an indication of impairment. I feel I go on and check, and then I found out that actually there is no impairment. In fact, the value in use I calculate now has come to somewhere around 150 crores. So can I increase the value? This is not revaluation. The standard does not permit any increase in value, but it allows for reversal of impairment. Last year, the 20 crores you reduced, no? To that extent of 20 crores, can I increase? Yes. To the extent of 20 crores, I can increase. But can I increase actually to the extent of 20 crores? No. It says, that is where the beauty of the standard comes in, where it says the carrying amount that would have been determined had no impairment loss recognized in the previous prior accounting period. Because last year 100 crores value I have reduced to 80 crores. This year my depreciation itself only 8 crores. So this year I'm showing the balance in the balance sheet. I'm showing it only 72 crores. If there has been no reversal, also no impairment, how much would have been it today? 100 crores, 10%, it would have been 90 crores. So between 72 crores and 90 crores, what is the difference? Only 18 crores I can reverse. Beyond that, I cannot reverse. Though my value in use, highest of value in use and net selling price is 150 crores, the maximum reversal that can happen is, commonly we will say 20 crores, because 20 crores only I reverse, no sir. That much only we will usually think. But think about it this way: had it not been reversed, had it not impairment not been booked in the previous year, this year depreciation would have happened, and that would have been 10 crores. So 100 crores would have become 90 crores. Because it is 80 crores, 8 crores depreciation has come, 72 crores it has become now. All that I can do is between the 72 and 90 crores, 18 crores only I will be able to reverse. This is one small point that I'll have to bring up. Reversal for an impairment loss for an asset should be recognized as income immediately in the P&L. Okay, one side you increase the value of the asset, debit the asset, credit should happen in the P&L. Straightforward. So what happens in the case of revaluation? Previously that was done, and revaluation reserve was reduced previously. What should I do then? The case of reversal of impairment loss on a revalued asset, it should be treated as a revaluation increase under the accounting standard. reversal of an impairment loss on a revalued asset is credited directly to the equity under the heading revaluation surplus. To the extent of previous surplus that was there, don't go beyond that. However, to the extent that an impairment loss on the same revalued asset was previously recognized as an expense, that should be first accounted for. Sir, 10 rupees revaluation reserve I reduced, sir. 10 rupees expenses, P&L I took, sir. What should I do now? First go and increase the income by 10. Then whatever is the remainder that is there, 8 rupees would be there. 10 and 10, na, last example, how much can I recognize now? Only 18 rupees I can recognize. 10 rupees should go to the P&L. 8 rupees only you can increase the revaluation. So don't do the ulta. First P&L, then only you go to the revaluation surplus. Cash generating unit, what should I do, sir? Goodwill and all will come into play. What should I do? Here the order is ulta. Don't first increase the goodwill. First increase the assets, then come to a reversal. Assets other than goodwill on a pro rata basis. Basically, whatever I did, same thing. Pro rata basis based on the carrying amount of each asset, you do go on to increase the value. If anything is there, go to goodwill, then it comes with a rider, which will come a little later. Increasing goodwill, Ind AS 36 does not allow for it. The moment you reduce goodwill as per Ind AS 36, it says that don't come back and ask for increasing goodwill and all. The moment it went out of the door, it is a one way, don't come back. But AS 28 is a little bit more considerate. It says, okay, it can be done, but with some riders. In the case of allocating of reversal of impairment loss for cash generating unit, the carrying amount of an asset should not be increased above. There they said no. Net selling price or value in use, whichever is higher, it should not go below that. The same way, lower of it, you cannot go above. So the recoverable amount or the carrying amount that would have been determined individually, we calculated. The same way, recoverable amount you calculate is determinable for the individual assets, and the carrying amount you calculate for the individual. You can make the calculation. If the impairment has not been done previously, what would have been its carrying amount today? You would have been able to calculate. Lower of that, it cannot go above that. A question has come. How many years backwards can we go while reversing an impairment as per the standard? There is no guidance as to this many number of years only will have to go. If it has been 10 years also, it's fine. But usually 2, 3 years, 4 years is where the value difference would actually matter. If it is 10 years back and suddenly now life comes for that particular asset, usually that will not happen. 2 years, 3 years, maximum 5 years you can look. Other than that, reversal usually will not happen. Justification for reversal will be looked at more seriously than actually impairing. The management would not be taking it lightly to go ahead and do an impairment done in their asset on their books. But they would be very happy if reversal is being done. If impairment has happened, reversal, they'll be very happy because the assets value is going up. They'll show it as if it is their performance. As an exception to the above, required above, an impairment loss should be recognized for goodwill. Should not be reversed in a subsequent period unless if you have recognized impairment for goodwill, then it is final in Ind AS 36. In Ind AS 28, it is final unless you cannot reverse it unless the impairment loss was caused by a specific external event of an exceptional nature that is not expected to recur at all, and subsequent external events have occurred that reverse the effect of that event. Number one, first, this reversal should have happened because not of an internal reporting, it should have happened because of an external event. And it should be exceptional in nature. That external event is exceptional in nature. It should be. And you don't, the management should not expect it to recur at all. Point number one. Point number two, another external event has subsequently happened that effectively reverses the effect of that event. How many of you understood? Who wants an explanation? Anybody who wants to come out and say what this means? Please unmute yourself. Take the liberty of explaining. because the idea is to have an understanding than learning. This part requires understanding. Okay, I'll give you an example. Two events happened because of which impairment has happened. One event for one particular cash generating unit, what has happened is internally we made an analysis. When initially budgeting and getting that cash generating unit, let us say Tata comes to Chennai, Ratan Tata comes to Chennai. He takes up the Chennai plant, and that Chennai plant, all the assets and the goodwill related to it, he is taking in his balance sheet in Tata Motors. He goes to Bangalore. He takes up all the assets in one plant, a different motor company. He takes up all the assets, including goodwill. As in, he pays a little extra and he takes it over in his balance sheet in Tata Motors. Now, what happens is in these two companies, one company is into making paper. A4, it is a stationery making company. Ratan Tata thought that Bangalore company, let us say it is the paper making company or a stationery making company. He went through the projections. The management of Tata Motors sit down, they do an analysis, and they figure out that was what we projected at the time of buying this company and what is actually happening today are two different things. There is actually a large deviation that is happening, and therefore we'll have to do an impairment analysis and impair all the assets in the Bangalore unit. Management signs off, impairment analysis done, and impairment has been booked. Chennai, they are making, let us take the previous example that I gave. Let us say that there is an order, Tamil Nadu government has come out with an order which says that single-use plastic is banned, manufacturing of single-use plastic is a prohibited offense. You can't do that. And automatically what happens? They stop it. Automatically impairment indication has signals are blaring. Impairment analysis is done. Impairment is recognized in the balance sheet. So Chennai also impairment has happened. Bangalore also impairment happened. 2023 financial year. 2024 financial year, another person comes, does an analysis for Bangalore unit. They find out that no. Actually, you are thinking that we can do it in this manner. Let us do one thing. We will run different shifts. We will use different raw material. We will use different methodology of selling. Therefore, the value will be so much higher, and therefore the value can be increased. The recoverable amount has increased. Go on to do a reversal. Go on to do a reversal of the impairment that you've done in 2023. At the same time, Chennai unit also, the government has backtracked. They've said, no, let's not get into all this problems. It's okay. Let us go ahead and do a reversal of the law that has been passed. Start generating. There is no prohibition of making single-use plastic. Now, in both cases, reversal happened. In the case of Bangalore, the reversal has happened and the impairment has happened as well as the reversal has happened because of internal reasons. In the case of the Chennai unit, their impairment happened because of an external factor which is not expected to recur, as well as it has been reversed by an external factor which is not expected. Recurrence does not come into play here. Subsequent external event has happened which has reversed the previously happened exceptional external event. In the case of Chennai unit, goodwill can be reinstated. In the case of Bangalore unit, it cannot be reinstated. That's the point. This is a classic example. Because of internal reasons, because of your internal budgeting targets, you have impairment has happened and reversal is happening. You cannot increase or reversal of goodwill cannot happen. Reversal of impairment of goodwill cannot happen. But if it is because of external reasons, you can go ahead and reverse the impairment. Specific external event is an event that is outside the control of the enterprise. Examples of exceptional event including new regulations that significantly curtail the operating activities or decrease profitability. Not necessary that curtailing operations only is there. Sometimes decreasing profitability can also happen. You might have to use this specific material which is a higher grade and costly, which is reducing the profitability. That can be an event, or of the business to which the goodwill relates. It should be relevant to that particular cash entity. The standard does not permit an impairment loss to be reversed for goodwill because of a change in estimates, which is the classic example of the Bangalore, where the previous estimate was made and different estimate was made. Yeah, go ahead. Somebody wants to talk? No. Fine. Let's move on to disclosures. I think we have come to the last leg. We'll take another 5 more minutes and I'll open up for discussion. Or we can go to the disclosures a little later. I'll address any questions if that is there. Then we'll go for disclosures. That's absolutely fine with me. Let's have a discussion, a 5-10 minutes discussion. And then if you have any doubts, I'll clarify that. Based on the time availability, I'll go into the disclosures. Disclosures is straightforward. It does not have much impact on valuers. It has more impact on the auditors who audit it, or the management who prepares it. So go ahead. Any doubts so far that you have? Any questions, doubts, clarifications? Okay. So then let me finish the disclosures first. Then we'll go here. First disclosure: for each class of assets, the financial statements should disclose the amount of impairment loss that is recognized in the P&L and the line item in which, in the statement of P&L, where it is been included. Where you are, for each asset, where you are bringing it in the P&L, you'll have to disclose. So the line item where the P&L, in the P&L where you are disclosing it, and what is the amount, you have to separately disclose. The amount of reversals, not only impairment, but in the case of reversals, separately, where the reversal is happening, what is the amount, line item in the P&L where the reversal is happening, you'll have to go on to disclose. The amount of reversal of impairment losses recognized directly in or against the revaluation surplus also has to be disclosed. So reversal as well as the impairment in the revaluation reserve, wherever you have given an impact, that needs to be separately disclosed. Case of segment reporting AS 17, for each reportable segment, you'll have to give the amount and the amount that has been affected in the P&L for that particular segment, or revaluation surplus pertaining to that particular segment, you'll have to separately disclose. The amount of reversals also, again, impairment loss recognized in the P&L and directly in the revaluation surplus during the period, you might have to reversal also, you'll have to go back and close. Disclosure, everything is disclosure. So there is not much thought into it. Whatever you've done, disclose it. Wherever it is reported, disclose it. Whatever is the amount, you'll have to disclose. Pretty straightforward. Wherever there is an importance, I will give you a heads up there. If an impairment loss for an individual asset or CGU is recognized or reversed during the period and is material to the financial statements of the reporting enterprise as a whole. Sir, my entire net worth is 100 crores, sir. I have an asset which is worth somewhere around 80 crores, sir. That 80 crores of worth of asset, I am taking there is an impairment that has happened, and I have gone on to do an impairment, and I have shown it in the balance sheet. Will it have an impact on the entire reporting enterprise? Yes, 100%. The entire reporting enterprise is based on this single asset. My value is 100 crores, asset's value is 80 crores. So it has a huge impact. In that case, what should I do? Not only amount and line item, I should also explain what all the events and circumstances that led to the recognition or reversal of the impairment loss. Small cases, don't bother to give me the story. Give me the amount, what you have impaired, what is impaired, what is reversed, that much is enough. But when it comes to a large impairment, where it is substantial for the reporting enterprise as a whole, Give me the story, give me the events and circumstances that led to the recognition or reversal of the impairment loss. The amount of the impairment loss recognized or reversed, this is already there. And then for an individual asset, talk about the nature of the asset and talk about the reportable segments. Then for cash generating unit, description of the cash generating unit needs to be given, because as a user of the financial statements, I will not understand a cash generating unit. So first you should go on to explain, give a broad description of the cash generating unit. And then we go on to give where in the reportable segment A17 does this particular asset fall in. If the aggregation of assets or identifying the CGU has changed since the previous estimate, the current and the former way of aggregating these assets needs to be given. This we spoke previously itself. If the asset C is moved from Chennai to Bangalore and asset B is moved from Bangalore to Chennai, disclose what has changed. Last year, this is how we have aggregated the assets as a cash generating unit. This year, this is how we have aggregated it as a cash generating unit. Separately disclose. Whether recoverable amount of the asset is its net selling price or value in use also needs to be reported. Again, these are not for all the impairments. This is only for impairments where the amount is material enough for the reporting enterprise. You'll have to also tell how did you arrive at the recoverable value. Net selling price basis, value in use basis, that you have to disclosure. If the recoverable amount is net selling price, the basis used to determine the net selling price also should be given, such as whether the selling price was determined based on a reference to an active market or is there a binding sale agreement. All the disclosures come into play. Recoverable amount is value in use, then the discount rates used in the current estimate or the previous estimate needs to be disclosed separately. So discount rate estimates they'll have to give separately. For all this purpose, so much disclosure is there. They will need a valuer separately engaged for assisting them in getting a report so that they can pick all these numbers and give it in the disclosure. The impairment losses recognized or reversed during the period are material in aggregate to the financial statements of the reporting enterprise as a whole, and enterprise should disclose the brief description of the following. Now, previously, one asset, if it is material enough, we'll have to disclose X, Y, Z. They have given it on. In this case, all the impairments that have happened, if you take it as a group together, 100 crores worth of company, each asset is worth 10 crores, but I have done an analysis and I have found out that impairment is 1 crore for each asset. So 10 crores I am going to do impairment. Then as an aggregate of all 1 crores of each asset comes to 10 crores, as aggregate it is going to have an impact on the reporting enterprise. Then I'll have to talk about the main classes of assets affected by the impairment losses, main events and circumstances. Even in this case, I'll have to go on to disclose. So we are closing out on AS 28. A broad understanding of AS 28 versus Ind AS 36 should be given. Just give me 1 moment, give me a 2-minute break, I'll come back. Okay, thank you. Moving on to differences between AS 28 and 36. AS 36 is also applicable on subsidiaries, associates, and joint ventures as defined under Ind AS 110, 28, and 111 respectively. In the case of AS 28, for financial assets, it's not applicable. Therefore, we don't have to get deep into it. So that's the reason we as valuers, SFA valuers, we have an opportunity to do valuation under for each subsidiary, associate, and joint venture separately under Ind AS 36 every year. They'll get a report from us. For large enterprises, they'll have to get a report from us. That's an opportunity area that is available. Next, AS 36 excludes biological assets separately related to agricultural activity. But in the case of AS 28, does not talk anything about biological assets. AS 36 requires annual impairment testing for an intangible asset with an indefinite useful life or not yet available for use and goodwill acquired in a business combination. These three things you'll have to do an yearly impairment analysis, irrespective of there is an indication is there or not. But in AS 28, only if there is an indication, we'll have to go ahead and do the valuation. If there is no indication, you don't have to go on impairment, do an impairment analysis. Now, when it comes to Ind AS 36, it prohibits reversal of goodwill. It's a one-way street. Goodwill, once it has reduced, there is no way of coming back to the balance sheet. So Ind AS 36 prohibits reversal of impairment loss from goodwill or loss of goodwill. In the case of AS 28, we have exceptional nature concept, where if it is of exceptional nature, then you can allow it. If it is because of reporting or if it is for based on internal nature, you cannot do it. Ind AS 36, there is no concept of bottom up and top down approach at all. The case of AS 28, that concept is there. I will close this session with this and open up the discussion part. Let's go ahead and have a discussion. Yes, any questions, doubts, clarifications that is needed? Let's go ahead and discuss. I think we have a solid, what is the time now? Phone somewhere. I think it's 5:48. Another 10 more minutes. We have time to discuss. I do not get much questions here. So if you have any questions, go ahead. I mean, either everything is understood. If that is the case, I am very happy. Or nothing is understood. That's a question. Give an example of reversal that you have actually done. I have not done any reversal. So personally, I have not done any reversal. But what happens is, usually based on internal reasons, auditors also don't allow reversals to happen because of internal reasons. I made a measurement today that this particular asset would get me so much only, and within a couple of years, I think it is going to change. Usually that will not happen. Internal reasons, it will not happen. But when there is an opportunity for reversal to happen is because of regulatory reasons, as I told you, which is not in the control of the management. For whatever purpose, there is a possibility that the company would have decided to hive off a particular division itself. So they take a decision, okay, I am going to hive off this particular division. They'll do an impairment analysis. In that context, good that you brought it up. In that context, that brings to my memory that when we are doing the calculation of net selling price, usually we should not take it as a forced sale, unless otherwise it's a forced sale. Unless otherwise the company is struggling, it is cash strapped, and it is supposed to sell off the asset on a forced sale basis. We cannot calculate the net selling price as a forced sale basis value. The basis of value cannot be a forced sale. It should be a going concern only. But when it is actually a forced sale, you can take it as a forced sale. Now coming back to the question, in that case, if internal decision is taken to hive off a particular cash generating unit, but at some point in time, the management, due to change in the management or change in heart of the management, if they are planning to stop that hive off to happen from happening, they're going to plan off on something. They're saying, oh, okay, this particular thing, we have been looking at it in the wrong way. Let us do it this way and let us try to put in more effort and make it successful. If that kind of an event happens, then there can be a reverse. So broadly speaking, I have done a lot of impairment analysis, but reversals usually does not happen. In fact, impairment itself does not happen that as frequent as you might imagine. Nobody wants to do an impairment analysis. Analysis is tough. Second thing is, why intentionally would I reduce the value of my organization and my assets? This topic is largely in the scope of SFA valuers. No, that's what I've been saying. The entire thing applies to plant and machinery valuers and land and building valuers also. Value in use, land and building, plant and machinery valuers also can do. For a letter, so all the examples I took, I did not take a security or financial asset at all. I've always taken a machinery, which is a P&M valuer's domain. So P&M valuer would have to do, because this is related to an accounting standard. An accounting standard is mandated through the Companies Act. If at all some shelter needs to be taken by the management, it needs to be done through the Companies Act and by a registered valuer recognized under Companies Act, which is us. We registered valuers who are recognized under Companies Act, we will be doing the valuation, and all the assets would come into play. In the case of Ind AS 36, subsidiary valuation, joint venture valuation, associates valuation will be done by SFA valuers. Plant and machinery valuers, P&M valuers only will do. The same way, land and building related, if there is a factory building that is there, a chimney that is there, valuation needs to be done. Who will do it? Only a land and building valuer should do it. And can they do it in their own method? No. The method is prescribed in the standard only. Based on that method only, they should do it. That is the reason this topic is very important. Who is supposed to estimate the recoverable amount for plant and machinery? P&M valuer or SFA valuer? Plant and machinery valuer only will do the valuation, not SFA valuer. SFA valuer will do associates. The associates in the investment section, the joint ventures in the investment sections of the balance sheet of the company, and the subsidiaries in the investment sections of the section of the balance sheet of the company. Only SFA valuer is empowered to do. P&M valuer only should do. We P&M valuers are not generally coming across such impairment cases. Very important. Get in touch with chartered accountants. Get in touch with auditors of large companies. These large companies where IFRS, in the international arena, IFRS is applicable, and in India, Ind AS is applicable. Wherever Ind AS is applicable, wherever accounting standard, usually small companies, they don't get to doing this impairment analysis. Large companies, because it is being in listed companies, at least because it is mandated, because it is being reviewed by other people, they have to do an impairment analysis. Get in touch with the chartered accountants, auditors. If you are able to network with them, at some point in time when there is a valuation assignment, you will definitely get it. I get a lot of plant and machinery related some assignment or the other would keep coming. They will get some references from SFA valuers. Because we are chartered accountants, we are already in their network. They ask us, we tell them that I cannot do it. I will refer a plant and machinery valuer. So get in touch with chartered accountants. That is how you get in with you will get this kind of assignments. Anyone else who wants to ask any questions, any doubts, clarifications? Definitely. Can you please speak about the income tax impact of impairment and reversal? Tax, let's Impairment reduces the net profit and thus tax liability. Okay, I actually am not qualified to give this opinion, because income tax, though I was good for some time, I have become a valuer, full and full valuer. Consulting and valuation has been my core area now. But from my limited understanding of Income Tax Act, because there has been a reduction in the value of the asset, and that reduction is happening only under the Companies Act, I will have to keep it only in my books. Income tax, they have a concept of block. It goes under the block. Whatever is in the block automatically automatically the calculation happens in the income tax block. So this is in the books of accounts, that is in the income tax portal. They are two different things. It will not have an impact at all. You cannot consider it as part of your expenses. That's what I'm trying to say. This is my limited understanding of the law. In case if alternate view is there, probably you might have to seek an expert on income tax matters. Any other questions? Anybody who wants to give an answer for that income tax question also welcome to answer. My understanding is income tax, the block is separate. Cannot, for the purpose, if I'm including it here, then income also I'll have to include, which is actually not done. Okay, so I think pretty much we have come to the conclusion of this session. Anybody from DJF, please take over from here.
Yes, sir. Yes, sir. So we come to the end of this session. I thank our speaker, Santosh sir, for very nice presentation. Thank you very much, sir. All doubts were clarified, and wherever required, there you have given examples. So very nice, sir. Thank you very much. Thank you, participants, for your participation. Perhaps you are aware that in this financial year, you have to complete your CEP points. Unlike previous years, the provision for completing the required CEP points is not available. IVVI has changed the rules. So please keep that in mind. Thank you very much. Please share your feedback. Thank you. Thank you, Kajal.
Thank you, sir.